What I'm going to talk about, and it relates to some of the activities we do at Reyker, is structured products. And I'll define a little bit more what it is, etc. in due course. At Reyker, we do different things. One of my colleagues presented earlier about investing around the world. We also develop and also have ability to design structured products that you could invest. But let's look at something first, just to cheer you up or give you something different to start with. I'm a Chinese, okay? After financial crisis, Chinese obviously have different view about the market, and this is one of the modern, so-called modern artist view. Okay, I don't know whether you see this. Okay, so it's by a Chinese sculptor called Chen Wenling, and this is in Beijing some years ago. You can't see it clearly. It's a bull, okay, giving out some gas at the bottom. I can't use that word, okay. This is a public occasion. That's a rude word, okay. But and then the guy who is stuck on the wall is supposed to be Mr. Bernie Madoff, and you can see there's a horn there. So therefore Madoff now finally get done by the bull who giving gas from the back. Now giving gas from the back, there's a couple of Chinese here. In Chinese here is 放屁, and basically what does it mean is basically you lie. So basically, if I'm Chinese, talk to basically, he lied to me and say you are giving gas from the bottom, and that's what it does. So basically, it's a Chinese way and say the bull market is a lie because he generated a lie, Mr. Madoff, so it come back and haunt him. So that's a Chinese view of the stock market. That's 2009. Talk about another one. It's an American, but that is not Bernie Madoff. That's Mark Twain. Anyone heard of this quote? Maybe you heard of this quote. Yeah. So be prepared what I'm going to say. Or Mark said about 100 years ago. October, a month away. This is one of the particular dangerous months to invest in stocks. Okay, another 14 days, etc. is October. He was right, wasn't he? 100 years ago, he predicted the stock market crash in 87. So it crashed in 87, etc., etc. But this is only first part of his quote. Other dangerous months are July, January, September, April, November, May, March, June, December, August, and February. So basically, that's his typical humorous way of saying that actually investing is just generally dangerous. And post-crisis, what we are facing is that investors are facing the first challenge is that the rates that you got in your deposit account, you're looking for safe investment, the rates were very low. Okay, about a week or so ago, this is in Europe, Lufthansa, which is the flagship German airline carrier, issued a 5-year bond, okay, that yield 1.1%. Those who are familiar with credit ratings, they're not investment grade. Lufthansa, they like to strike once in a while, and it has been basically losing money. But that's what you get for that type of company. That's the bond yield. Okay. Secondly, you want yield and safety at the same time. So one of the things people start to look at a slightly different source of investment. This is a strip I got from the internet, and that is probably one of the common view of people in stock market investment. Basically, you put in there, and someone smarter take advantage of you, and you lose most of your money. Some of the investors know that, and therefore they start using what we call structured products. And this is when I'm going to start talk a bit more about this. Before I go into this, just wonder in the audience, among the audience, have any one of you have invested in structured notes or structured product, exchange traded structured product before? Good, none. Okay, so I may have to convert you by the end of this talk. But if you're interested to know more, we have a guide on our stand. Come afterwards, and this is an educational guide to tell you more how the structured products work. But what I'm going to do is give you a 2-minute overview about structured products. Typically, it's a loan to banks. Therefore, you either, when you invest in a structured product, you either hold a bond, sometimes a warrant, sometimes a preference shares, doesn't matter. But basically, whatever format it does, it's more like a loan. So you basically lend money to the bank, or deposit. Now, if you basically lend money to a bank, like a deposit or bond, you should get interest. A structured product or a structured note, in that you basically give up the interest, you still get a return. But the return now is obviously just like a bond, determined on predetermined dates, but it's linked to a certain underlying indices or investment. For example, I can buy a 3-year bond with a bank paying 3% per annum. I would say, I don't want the 3%, it's a bit too low. However, I'm willing to take some risk on the return. So instead of getting 3% per annum, I get paid at the end the return linked to an index, for instance, FTSE 100. So you may get 10% or 20% depending on how much the FTSE rise. Obviously, if the FTSE doesn't go up, you got nothing. Okay, so that's the basic form of structured product. And many people use it that way as an alternative to enhance the yield in the portfolio. This one. Obviously, I just told you that there's a control on the risk. So the example I gave you is that if the index does not go up, you got your money back. We call the return of capital. Unlike during the financial crisis, people like return on capital. They keep asking me, is it 20% or 30%? Now they just make sure they got the money back. So there's a control on that. We could actually also put in measures there, and it's in the guide, and I'm not going to bore you with all the details, but they call it barrier protection. And basically what it does is that you get your money back unless the index, let's say, drop 50% at the end of 5 years. So FTSE is 6,000, unless the index is below 3,000 at the end of 6 years, then you got your money back. So you build in condition. When you build in condition your capital return, your return is even higher. So we start again. A bond, you give up the interest, you basically have a return linked to certain underlying indices or shares. It becomes variable. If it performs, you potentially get better return. But it doesn't perform, you may have no return. To make that return even higher, I start taking some risk. And one of the way to do some risk is to get a controlled degree of risk using barrier. So that's another feature. A lot of people use this in their portfolio and say, you know what, I could buy ETF. Some of you attended an ETF section earlier and said, I could buy ETF, the index go up 1%, I got 1%. Index go down, I lose money. But if I build in these barriers and have these controls there, it helps. Third reason why people do structured products is they utilize strategies sometimes that did not need the market to go up to produce yield. What do I mean by that? For instance, there are plans basically or structured products out there that if the stocks or the indices stay at the same level at the next year or the year after, you still get a return. Now, this appeals to a lot of people. We say, FTSE is going nowhere. Okay, we know that. Go to 16,900 seems to get a resistance, and then basically go down 6,700, people buy. So basically going nowhere. So unless you trade very often, you can't actually, it's very difficult to get return. So it's an alternative. Okay, doesn't need the market to go up. As long as it's at the same level, next year you get a return. Similarly, with the products out there that, for instance, we have just one done linked to European indices. At the end of 6 years, it paid 10 times the growth. So how can you do that in a normal investment? So all this are like an alternative. So what I'm trying to say is structured products is an alternative way to gain exposure to an investment with slightly different features that you don't get in the traditional investment. Risk control, enhanced return, strategies that basically can produce return even if the market doesn't go up. So that's the features. So I hope now you get an idea about structured products. As I said, you want to know more, there's a guide there. So I could tell you more afterwards as well. I'm going to skip this slide and go straight into this. Because you came here, try to listen to me trying to tell you trends and innovations and developments. So I'm going to tell you in the next 10 minutes and 50 minutes. 3 areas I want to talk about. I want to talk about the trends about issuing banks. As I said, most of the structured products are like loans to banks. So that the banks will be taking your money and issue a structured product that give you the return. I'll show you some trends there. Pricing environment. I'll discuss a little bit on that. And finally, innovation about strategies. Look at issuing bank first. It's a table basically compared to things about 5 years ago. So the first column is in 2009, how many banks are regularly issuing structured products, either directly sold by them or distributed by a broker, a plan manager, or other promoters. In 2009, there are 4 banks very active. In other words, most of the banks in the UK are very active. Now, 2. So the number of banks, UK banks, in the game has shrunk. We all know, we heard about change of business model of banks like RBS, Barclays, etc. So they start to say, I'm not sure we want to do this business because of regulations, etc. So they start to exit the market. There's one German bank quite regularly doing it 5 years ago, and that bank is still active. There are 2 French banks that are quite active in 2009. They are still very active now. In fact, they become even more active 5 years later in 2014. So Switzerland, 2 banks, and 2 banks, actually, one of them is even slightly less active, but the other get more active, but still 2 banks there. You look at that block there, non-UK European banks basically stay in the UK market. So they get into the market and say, okay, UK banks, you're not there, doesn't matter, I'll try to take the gap. US and Canada, North American banks, in 2009, 3 of them only are doing it regularly. In 2014 now, 5 of them. After the financial crisis, 2009, balance sheets repair, they're more confident to do it. So what is happening is this. 5 years ago, when you go to buy a structured product, the issuing bank are very likely to be very familiar names that you have heard of. The HSBC, the Barclays, etc. Now, you can still buy this, and there's still good high credit quality banks, but most of them are non-UK. So, you need to understand a little bit more about these banks. And therefore, one of the things we would do often is that we talk to individual investors or advisors about some of these less familiar names, Canadian banks, Swiss banks, etc. And give them the comfort to make sure that they know about the banks that they are choosing. So that's the first trend. UK banks exiting. You do use structured product, you now use more American and European banks. Now, the next few slides are some charts, okay? I'm going to talk about pricing. Now, pricing is probably the most boring thing, unless you basically, like me, a little bit of a nerd, and basically like to know how these things work in the models, etc., etc. I try to not be too nerdy on this, but basically there are things that affect structured product pricing. Think about it. I have a 3% bond, or a bond that pays 3% per annum. I give up the interest and I actually create a return. Okay, that affects how the interest level actually obviously affect what return I'll get from the link to the index. And similarly, the credit spread of the banks affect it. A lower credit rating bank, you expect that actually you get compensated and you get better terms. And there's another factor, which is volatility, which I'll explain a bit more. Okay, I hope you could see this, courtesy of Bloomberg. I don't know why they use a dark screen, but there you go. Basically, it's a chart. It's a 6-year interest rate, and it's going from 5 years ago, 2009. You can see it's quite high, and then now it's about 2.1%. It dropped to a low, and then Carney say, I may raise, it come back up. But still, historically, it's quite low. Interest rate remain around 2%. Okay, when I start doing this type of things in the 90s, interest rate is 7%. Remember, Bank of England at that point was not independent. Now it becomes independent. We are still in a weak recovery phase, so interest rate very low. As I said, one of the things you do is you give up the interest in exchange to get potential upside and return. The more interest you get, the more potential upside you get. Now, in the reverse, the interest rate go down, so doesn't get that much upside. So that's one. Okay, this is Barclays. This is what they call credit default swap. I'm not trying to do a derivatives course here. Let me just tell you what it is. It's basically the credit spread. You buy a bond of Barclays, you basically take the credit risk of Barclays. So usually there's a spread above the rates. This is in basis point. In the peak, okay, probably you can't see it there. You're talking about 3% above interest rate. So if you basically, let's say at that point, interest rate 2%, when you buy a Barclays bond, you expect 3% more. Okay. If you move to another bank, there's no such bank. But Bank of James Chu, never heard of. Okay. I can promise you 20%. Take the money, and basically I'm definitely, the credit risk for me is quite high. Always don't know me, etc. And by the way, I take your money and probably disappear, just like Bernie Madoff. Anyway, so that's the other extreme. So you expect the world's global bank, HSBC, a bit more solid. You don't expect that level of credit spread. So you could move around the banks and basically say, okay, I could use some banks a little bit more, what's the right word, a little bit more different or lower credit rating. So that's one of the choice that were used before. But now, look at what happened. After that peak there, it's go down like a straight line. And at the moment, that spread is about 0.5%. I haven't got every banks there, but I can tell you that most of the banks, American, European, Switzerland, UK, they're all about 0.5%. Okay, it's because all the banks now got different types of rescue mechanism that actually allow them to get the money. So the credit spread that you get, or the spread that the banks want to pay you to taking risk with them, collapse. So these two means that I do not have that much interest to pay, so the terms of the product is affected. Third is a volatility aspect. This is a options volatility, and basically you saw that shot up in the peak. That's around the peak of the financial crisis of 80%, and it's now only 12%. It's collapsed. Volatility is important because some of the structured product that we use actually relies on high volatility. If volatility is low, then I couldn't give the terms. So What I'm trying to say is that these all factors combine. In low interest rate, credit spread become compressed and can lower differentiation, and also collapsing FTSE volatility means headline rates under pressure. So structured product providers now, they all see that in, say, 5 years ago, 3 years ago, I could do something that pays 8% per annum, for instance. Now, if I'm lucky, I get 5%. So, however, in the past, I could move around and say from Barclays to Morgan Stanley, from Morgan Stanley to Citigroup, I could get different terms, especially some of the American banks or some of the European banks pay me better yield. That trick is also gone. So differentiation of terms between banks reduce. So they look for ways to improve headline rates. So in the past, a lot of structured products use indices. Most of the structured product, you go Google it, structured product, you see it's FTSE 100. Mainstream indices, everyone know. Very liquid as well, so the derivatives are more easy to do. Now they start to use indices like Euro Stoxx 50, which is Europe. Go to S&P 500, okay? And now they also start using stocks, individual stocks. Okay, you think about it. Indices, broad, diversified. Stocks, a few, 3 or 4 stocks. Okay, 5 stocks. The risk is different. So you, by moving from indices to stocks, you take a higher risk. You take a higher risk, higher return. I'll talk about that. I'm going to introduce a jargon in 2 minutes. And then increase the complexity of how returns are determined. So some of the ways that actually the returns are determined is so complicated now that even I can't explain it. Okay, so that's one way. They say this gives you 30% per annum headline rate. And I'll show you something as well, just to show you how complex it is. And obviously, there are ways that I could increase credit risk. Remember, I take credit risk, better return. Okay, I'm going to show you a product. Okay, I'm a structured product derivatives man, so it's a very dry, boring way of presenting. But hopefully, you get a catch. You get a gist of things, and there's a catch in this thing. Okay, I want to see what you think. Jargon number 1, kick out. Okay, I'll explain what it is. But basically, you buy a 6-year structured note. Okay, start with American Bank back. Linked to 3 shares. Blue chip, FTSE 100 shares. Barclays, GlaxoSmithKline, Vodafone. Okay? You love the next point. Year 1, if all 3 shares are above the starting level, you got your money back at the end of year 1. You don't have to end of year 6. That's the one we call kick out. So you automatically get kick out and you got your money back. But the good news is you got kick out, you also get a return. This is good. 30% return. Okay. Remember what I said. Market flat, you get a return. 3 share and above the starting level, get 30%. Lovely. Okay. What if one of the share is down? Okay. Kick out doesn't get trigger, but we will test it again in 6 months. So let's say Barclays is down, but 6 months later, all are above the initial level again. Then the kick out happens. You got your money back before the end of 6 years. This time is 18 months' time. And you accumulate and that's 15%. So 45% return. Gosh. So what's going to happen is that if the thing happened at the end of year 6 is 30.6, 180% return. Okay. 3 shares. Okay. Barclays, GlaxoSmithKline, Vodafone. Okay. Okay, this is very lengthy, but basically what I'm trying to say is there's possible capital risk. This is where the barrier features comes in. Basically what it means is that if the kickout hasn't happened, so one of the shares or keep going down, etc., get to year 6, we look at, and one of the shares are still down, we look at whether they have halved. If any of them have halved, you lose money. Okay, otherwise you got your money back. Okay, let me stop there here first. Has anyone understood what I'm trying to say? Good. Excellent. I do a good job then. I should be hired by this firm as a salesperson. It's not by us anyway. 30%. What's the catch? It's not Bank of James Chu. It's a proper bank that I can't name, but it's a proper big American bank that issued this. Distributed by a third party. What's the catch? What do you think is the catch? Will you invest in this? How many want to invest in it? Excellent. Excellent. I have now done a sales job for my competitor. It's not very good. Okay. One of the things we look at is what's the likelihood of all these free shares stay at the same level? There are 3 different sectors. You got a bank that's under more regulatory pressure, under new CEO. You got GSK, pharmaceutical, solid firm, but pharmaceutical. And you got Vodafone, who after they sold the Verizon bit, etc., doesn't seem to know what they're doing, has tanked quite a bit the share price. 3 different sectors. If the performance of each sector is very different, then obviously one of them may not be above the initial level. The second big thing is that you all invest in shares. Okay, I own some shares that I invested like 2 years ago, but if they go down, they stay down. Okay, so here's the catch. So think about it. Those who raise their hands, obviously, you come to me, then I'll show you my product instead, not the other competitor's product. But think first, and sometimes things that looks too good to be true are too good to be true. But that's the trend. On the structured product side, we're now seeing people doing this type of more complex strategies. This is what we call a worst of strategy, because it depends on the worst performing share. Okay, and it's very complex. So I think I'm going to go through this very quickly. I want to give you 3 or 4 questions that you should ask yourself before investing in structured product, any structured product. It's just common sense. Firstly, as I said, how can I get this level of return? 30%, 10%, 20%. So as I said, look at the choice of underlying investment. Do you understand them? Do you have a view on these individual shares? The conditions that when returns are paid out, as I said, in this case, returns are paid out if the shares are at or above the current level. Some actually allow the shares to drop or indices to drop to get some return. So look at that. Complexity of payout strategy, to understand it. Okay, I seem to have done a good job to explain it, although it's probably about 10 minutes to explain this thing. So, but that's the complexity. Do I understand the scenarios that I'll get the headline rate and how likely that they will occur? As I said, think about the free shares. What's the likelihood that the free shares will stay at or above the current level? Think about the likelihood. When will I lose money? What's the likelihood? One of the things during the financial crisis is that Lehman Brothers do back some of the structured products in 2007, 2008. They collapse, then you lose money because of the credit risk there. And I said about barrier, etc. So you have to think about whether one of these stocks may halve or more than halve, and I will lose money. That's the questions. Now, I mentioned the fourth, which is credit risk. So these are the fourth question you should ask. At the end of the day, if you don't understand something, you think it's too good to be true, ask us. We're there for you. We're Stand 21, but we do this day in and day out. We have wheels, etc., about these things. But we also have been in this industry for a long time, and we will more than happy to help you to demystify some of these products that you see. And that's the end of my presentation.